What causes outstanding share count of a company to change over time? Publicly listed companies will often, in their annual reports, include the total share count, the outstanding share count of the company, which represents the total number of shares that have been issued. But that's a number that for many companies can change pretty often. Sometimes it can change dramatically. And then for other companies, they may not change over time at all. I'll give you one example of a change of this kind. The company, EMX Royalty Corp., where the website's located at emxroyalty.com, on their investors tab, they've got a financial statements page. I've got a report opened up, which is the first quarter, March 31, 2025 financial statement. And on page 3, on the income statement, at the bottom of the page, they have listed their weighted average number of shares outstanding. I won't get into why or the difference between basic and diluted, but we'll just look at this column right here, this row for basic. And we can see for the period ended 2025, March 31, there's a bit over 109 million shares. Whereas over during the period of 2024, March 31, the number was 112. Why the change? Well, there are a variety of reasons why the total outstanding share count of a company can change, and it's good to be familiar with them, although it takes a while to become familiar with the different reasons. I'll go over some of those reasons right now. The first I would point to are stock options and warrants. Quite often, companies will issue stock options to their employees and warrants to investors as well, as they treat it as a form of currency, as a form of payment. They may do that to incentivize the employees into feeling like they have more skin in the game and to work harder and longer hours for the company over time, to feel more vested. In the case of investors, they may want them to feel that they've got more upside as well. So they'll issue stock options. And if those stock options or the warrants are exercised by the employees or by the investors, it can cause the total outstanding share count to grow. So it depends on how much have been issued by the management team at the company. Buybacks. Company buybacks can lead to a decrease in the total number of shares issued over time. This is where the company itself goes out into the open stock market or possibly from an investment group or investors directly and buys shares of their own company back. That's why they call it a buyback. And what that does, technically speaking, they may keep the shares they bought back in treasury, but those shares can be considered as having reduced the total share count outstanding. The reason why a company might do that would be to improve the valuation. When investors and shareholders go through their valuations of the company, they'll be using a smaller number based on the reduced total share count as a result of the buybacks. So buybacks can impact it too. Acquisitions and mergers. Company A may acquire Company B, and they might issue some of their stock to pay for Company B. They'll use that stock as a currency. Also, they could purchase specific assets from other companies or from individuals and issue some of their stock as a form of payment, again, as a form of currency in exchange for that asset. An example could be a portfolio of land, some gold mines, or some oil wells, or a strip of apartment buildings. The company could issue some of their shares, deliver them to the owner in exchange for taking over ownership of those assets. And then also a merger. Company A might merge with Company B, and they would rearrange their total share count amongst the two companies. And they possibly might change the name or keep one of the two names. The investor might experience owning a different number of shares or a different percentage of the company after the merger is complete. And then also share issuances by the company to raise capital. A company might need to put a new factory into production, and they might need to raise $10, $20, or $50 million. And so they may issue, let's say, $50 million worth of their stock to investors. And so they'll print new shares. So it will result in an increase in the total number of shares outstanding. And they might also issue stock options and warrants along with the new shares that are issued in exchange for the money that investors put up to help them put that factory into production. Also, stock splits. For a few reasons, a company might decide to split the stock, let's say 10-1, meaning that if you own one share of the company would multiply its total number of shares outstanding by 10. So you would then see 10 total shares inside your brokerage account as opposed to the original one. And they might do that to reduce the quoted share price for the company. Let's say a company had shares that were priced at $500 per share, but just for psychological reasons in the marketplace, they wanted shareholders to see a $50 share price as opposed to a $500 share price. They might do a stock split where they split the stock 10-for-1, and then at the opening of the trading, after the split is complete, the price of the shares will then be quoted at $50 per share. So that'd be an example of a stock split. And that can cause the total outstanding share count to be multiplied by whatever the ratio is of the stock split. The same thing could be done in reverse. If there's a reverse stock split, let's say, for example, the company, for logistical reasons related to trading the stock, might feel that the share price is too low. This could be the case for a company that may have shares that are quoted at 1 penny each, where the bid might be half a cent and the ask might be 1 single penny. That is a huge spread. It would cause the price of the company, the market capitalization, to either be cut in half or to be doubled based on the spread, the difference between that bid and ask. So in that instance, the company might do a reverse stock split where they condense the total number of outstanding shares, resulting in a higher quoted share price at the open when the shares reopen for trading. So let's say in that instance, a company did a 10-for-1 reverse split. And before the split, the companies were trading at 1 cent each. After the 10-to-1 reverse split, the shares would then be trading at 10 cents. They would open up at 10 cents for trading. So those are a few examples of what can cause the total outstanding share count to change for a company. It can involve compensation. It can involve acquisitions, mergers, raising capital, as well as splitting the shares for convenience of trading in the open markets.